Hello and welcome to the DIY Investing YouTube channel. We're working through every company in the S&P 500, and today is DXC Technology Corporation, ticker DXC. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. First up, this is a relatively small company from the ones we've looked at. Its market cap is $6.7 billion, enterprise value of $8.1 billion, just over a little bit of $1 billion in net debt, so not a significant amount on this business. This is in the IT services industry. Let's look at the business description. So they provide IT services and solutions primarily in North America, Europe, Asia, and Australia. So most of the world operates in two segments: global business services, global infrastructure services, analytics, ecosystem, accelerate digital transformation, software engineering, consulting, data analytics, creation, modernization, delivery, maintenance of secure applications, GIS segment, legacy apps, cloud, migrate to right workloads. I don't really understand a lot of what they're doing, but basically IT services, IT infrastructure, outsourcing, various things like that. So the beta of 1.96, relatively high volatility, tends to be something that you see in lower quality businesses, but we'll see what the rest of the data tells us. The return on invested capital chart is interesting. First thing I see here is two big losses, a very large loss in 2012, a very large loss in 2020. These losses are so large on this chart comparatively that it makes me think that they wiped out many years of profits. We'll see if that plays out when we dive into the data. Now, because of these being so low, it really makes it hard to see the cyclicality in the rest of this business, but you can see that there is quite a bit of bouncing around. In 2003, you're at 6%, up to 10%, down to 4%, up to 11%, down to 7%. So you are bouncing around. There are some miniature cycles taking place here. 2013, you hit a high of 16%, get down to 0% in 2015, lose money again in 2017. So you lose money in 2021. You've lost money in 5 years out of the last 20. That's actually a significant amount. So you're losing money in 25% of the years, once every 4 years. That's quite a lot, especially over the last decade. You've basically lost money almost every other year. Quite a large amount. It looks like the business has gotten worse since 2011, from what I can see here. So not too good, and it's very unpredictable. So I have some major concerns with that there. In terms of the quality, this tends to suggest a lower quality type business. Now, when we look at the 10-year median returns, this is, again, not very good. When you think return on invested capital of 5.5%, return on equity of 10%, when you consider how much they've lost money over these years, this is actually quite poor. Your geometric return is going to be worse than this. So when you see a return on equity of only 10%, you want to be buying it at less than book. But of course, the current price is above book. Now, on the surface, a PE of 12.5 is pretty cheap for most businesses. We'll see if that plays out here when we dive a little bit deeper into the numbers. A lot of it depends upon how reliable our profits are. And when we see this, is this based on the 281? Yeah, so you have $2.81 in earnings in 2022. But how reliable is that number? You lost money in 2021. You lost $20 of earnings in 2020. So that's, wipes out this number, this number, this number, this number. Basically, you lost money overall since 2014. That's really bad. So you take all the profits and all the losses of 2014 forward, and you haven't made any money for 8 years. That's very poor for shareholders. Should be a major, major concern. This is exactly what you'd want to avoid in a business, is when you can have a single loss wipe out a decade of earnings. Very, very concerning to see that. Now, we're going to have to dive a little bit deeper into those numbers, see what's causing that, but it's a very big concern. And again, it makes this PE ratio really hard to tell. I mean, if you were earning 281 steadily, that's one thing, but you've not earned $2 or $3 a share anywhere else in the last decade. You earned $1 in 2016. You earned $6 in 2018, $4 in 2019. What are their earnings and how predictable is it? I have no idea. You can see that they had to cut their dividend and eliminate it completely in 2020. This negative 100% dividend growth, very poor number here. One of the things that would be very concerning to me as a shareholder is you have 4 straight years of declining revenue. So you started in 2013 at 14.9 billion, you declined in 2014, you declined in 2015, you declined 41% in 2016. That's really, really bad. Now it ramps up a little bit into 2018 and then it declines again for 4 straight years. It's very hard to run a good, successful business when you have declining revenue. It's very, very difficult. I don't buy declining revenue businesses because of this problem. It's very hard to sustain. It's very hard to plan as a management team, and it's very hard as a shareholder to know what to expect going forward. This would be something I would avoid just because it's very hard for me to predict and project the future. If you're enjoying this video so far, even if you don't like this company, please hit that like button. That like button really helps me to grow the channel. Please hit the subscribe button if you're new to this channel. I cover every company in the S&P 500, and I think you will enjoy the ride. At the end of the video, I'm going to have a playlist where I've covered over 150 of the companies so far. I think you'll enjoy checking that out. So let's go to the income statement now. See what else we can determine here. I really want to understand this 2020 number. So what we do see is that although you had a positive operating profit in 2020, there's $5.6 billion in non-operating income. I'm wondering if this is a write-down. So let's go to the balance sheet, see if we change our goodwill. Yeah, so you can see the goodwill dropped by $5.6 billion. Let's see if that was the amount of the write-down. $5.6 billion. So they basically wrote off a bunch of goodwill. Now, on the one hand, you might say that this is a non-cash charge, so it doesn't really matter. The problem is, this means that in the past, they made an acquisition which they overpaid by $5.6 billion. The current market cap is only $6.7 billion. They basically wrote off the whole company. 80% of the company, 90% of the company. So they bought something for $5.6 billion or more than that actually, because of what this goodwill went up by so much, and they wrote it back down. And then the next year they wrote it off again, it looks like, in 2020. You know, they did something here, something weird in 2021. But anyway, their goodwill gets dropped off again. You see they're writing down their intangibles. Basically, this is overpayment. There's no other way around it, and that's a really poor result because what you have is you still have the debt from this acquisition. You just don't have the assets, and that's a really bad thing for shareholders. See if we see the cash flow. Look at these acquisitions. You see they're making acquisitions this whole time, issuing debt, issuing shares to make these acquisitions, and then they're writing it off. Or maybe they sold some of this too. It looks like maybe, I don't, these numbers are just really, really poor for shareholders. But this is a big loss. It's not going to affect the future so much as it tells you about the past. It tells you about the management team that made the decision. And so if the management team's different, if they're not going to do this again, then okay, maybe the future's okay. But the big problem is if you still have the management team that made this really, really bad decision that led to this, that would be a concern for me. And this alone would be a reason for me to avoid it. It does mean that this chart looks worse than it really is because this isn't an operating loss, that you're actually making an operating profit. But you could avoid it because that management decision. You could avoid it because of the 4 years of revenue declines. You could avoid it of these 4 years of revenue declines. You basically only grew revenue in 2 out of the last 10 years. That's something that's very, very concerned to me. So even though you're making operating profits, the fact is the revenue is very hard to predict. It's very difficult to be sustainable when you have revenue declines like that. So I would avoid this company myself. It's not going on my watch list. I hope you've learned something from this. I hope you like this video, subscribe, ring that bell. I'm uploading videos Monday, Wednesday, Friday every week. 3 different companies each week of the S&P 500. We're going to hit all 500 companies. The playlist at the top is the 150 I've already covered. I hope you will check out that playlist of S&P 500 companies. And if you are interested in this software that I'm using, this is quickfs.net. The link is in the description below. It's the first link. That is my affiliate link. And I encourage you to sign up using my link. That is a way to support this channel because I receive a commission, whether you get a free or paid account. It's a great way to check out this software. I find it very useful for doing a quick 5-10 minute analysis on a company, just like I'm doing in these videos. I hope you'll check it out. Till next time, stop paying fees, start building wealth.